Fast fact. Though home-based lending has been around since the 1930s, home equity lines of credit did not become popular until about 40 years ago. Between 1982 and 1988, the total value of outstanding home equity loans grew from $1 billion to $188 billion. I'm Drew Thomas, and you're listening to Bank Chats. So, welcome to yet another episode of AmeriServ Presents Bank Chats. I am your host, Drew Thomas. With me, my part-time co-host, full-time editor, and production manager, Jeff McTavish. Hello. And we'll introduce our guest in a second because we're going to talk about... I can kid with our guest that way because he was actually our very first guest on the podcast. Our very first guest.
This is going to be Dave O'Leary returns.
Dave O'Leary returns.
My popular demand.
Well, there were demands, but I don't know if they were.
They were made on me.
So we're going to talk home equity loans today.
Yes.
And so just since you already spoke up, let's go ahead and tell people, just refresh people about who you are and what you do.
Okay. My name's Dave O'Leary. I'm the vice president of residential lending, which is typically more involved with what's considered, and I'm air quoting here, mortgage loans. Previous to that, I was in the consumer lending department where I was involved day to day in home equity loans.
Yeah. So home equity loans, I mean, I started looking up some statistics on home equity loans, and we live in an area, just, full disclosure, where we record and where we live is traditionally speaking, I would argue, less affluent in terms of home values and things like that than the typical home value across the United States, right?
Yeah.
So if you live in LA or Chicago or Miami or some of these places, your average home value is probably $300,000-$400,000, where around here it's not usually that high. But we're going to talk about how HELOCs tie into home values and things like that. But the average home equity loan or line of credit balance is about $25,000, $26,000 right now as of the end of 2023. And the average credit limit per account is somewhere around $70,000. So we're going to talk a little bit about what that means, how you find equity in your home, whether or not you should take out a loan against the equity in your home, and what the difference between a loan and a line of credit. So let's start there. When we talk about home equity lending, right? People say home equity loan, they say HELOC as a shorthand, but really a HELOC is different than a home equity loan, right?
Correct. The HELOC stands for home equity line of credit. And the last part is the part that you need to concentrate on, because the line of credit means your loan or the line of credit acts as a credit card. You can draw on it, you can pay it back down, you can pay interest only if you choose to, you can pay interest and principal. It's a living thing. You have a limit and you can run it all the way up to the limit, then you can pay it back down as much as you want, and then you continue to draw on it.
So which is more popular for people? Is it more popular to get a home equity loan or more popular to have a line of credit?
My gut is we actually stopped offering home equity loans probably 14 years ago.
Okay.
We just weren't getting that much business from it.
Yeah.
Home equity lines of credit, the HELOCs, actually give the borrower a lot more flexibility, and I think it's just more attractive.
Yeah, I mean, from what I could see, it seems like that is typical of just about any bank, is that home equity loan is not really very common these days. It's mostly a home equity line of credit. And right. I think for the same reason that you just described, it's fluid. Mm-hmm. You can take some out, you can pay some back, but it's always kind of there for you like a credit card would be. So why would I do that as opposed to having a credit card?
Well, for one, the rate is significantly less. And your availability is probably going to be significantly more because a credit card's unsecured. If you stop paying your credit card, there's not a lot short of taking you to court and filing a judgment against you that the credit cards can do. Mm-hmm. A HELOC is actually secured by your home. So as a result, it's a lot less risky for the bank. So the rate's significantly less. I mean, these days, if you're lucky, your credit card rate is going to be in 24, somewhere in the 20.
Yeah, that's true.
I just happen to look at my Best Buy card. If you're not using it for,
And after you got up off the floor,
well, I only use it for the 0% things. I keep it in a drawer in my house, but I actually looked at the statement and it was like 27% or something if you use it as a regular credit card.
we've talked about that with different credit cards in the, on the show, but you're right. Like department store, quote unquote, I'm using air quotes now on an audio only podcast.
Yes.
It's so, but
if this goes video, I'm ready for my close up.
Mr. DeMille. The specialty store cards, I guess you'd call it now. I don't know how many department stores are still really out there other than like Macy's or Boscov's or something like that. But those kinds of cards tend to have much higher interest rates even than your standard sort of MasterCard, Visa, Discover, those kinds of bank kind of credit cards. Although those interest rates are pretty high right now too.
Yeah.
So when we talk about home equity loan and you say that like the interest rate is lower, is it based off of a mortgage rate?
Well, so the majority of HELOCs are based on an indexed rate. It's a floating rate because it can last forever. It could last 50 years. Okay. So it tends to be like, for example, the AmeriServ uses Prime. I think most HELOCs use Prime as an index rate.
Okay.
And Prime is more or less going to sort of float along with whatever the current cost of money is. It's going to be higher a little bit than cost of money.
So when you say Prime, that's like the Wall Street Prime rate?
Wall Street Prime rate. It's 8.5 right now. I mean, 5-6 years ago, it was like 3.25 or something like that.
Yeah.
So it's been going up. It typically follows what the Fed's rates are. So,
okay.
The Fed hasn't lowered a rate in a while. It's just been raising rates. So when the Fed raises or lowers a rate by 1/4 point, the Wall Street Journal announces Prime is lowered.
Yeah. And just
the same.
And just for the sake of the fact that these episodes live in perpetuity, we're recording this in April of 24.
Correct.
Right. So any rates that we may discuss, chances are by the time you're listening to this, they may or may not be the same. So please keep that in mind. Right. But it's hard to talk about rates without at least mentioning rates. Right. So
okay. Going back to the credit aspect.
Yes.
So these loans are secured by the equity in your house.
Right.
So if you don't make a payment, if you defunct on your payments, does that hurt your credit score as much or?
Yeah. I mean, typically your credit score will sort of bump along if you're making all your payments on time, and typically will sort of rise or once it gets to a certain plateau, depending on what your current debt load is, how much debt you actually have. Let me go back and just say the one thing I say whenever I talk about credit scores. Anybody that tells you they figured it out is a liar. I have seen people who have never heard anybody in their lives have credit scores in the low 6s. And I've seen people with bankruptcies 2 years ago with scores in the mid 7s. So like it's all on a logarithm and there's no rhyme or reason to it. But.
Not to get too far off topic, but there are 3 different credit bureaus out there too, primarily.
Yeah.
That people use, and the scores can vary from bureau to bureau.
Right.
So
they all use a slightly different formula. But getting back to your point, yeah, I mean, if you default on any piece of credit, it's going to start having an immediate negative effect on your credit score.
You mentioned obviously that one of the advantages to having a HELOC is that it's secured by your home. The interest rates are lower, but you also mentioned that there's a possibility of the idea that, well, because it's secured by your home, if you default on the loan altogether, the bank that holds the loan could use your home and basically come after you. That's not a typical response though, right? I mean, we kind of talked about that during the mortgage conversation that we had, where the bank is not trying to bilk you out of your home.
Yeah. Foreclosing on customers is not a sound business practice or a business plan. It is a last resort.
So one of the things that we try to focus on this show is clarify what banking terms mean. So let's talk just a minute about the term equity, because I don't know how many people really truly understand what that is. So there's a simple way to explain what equity is, right?
Right. So let's just say a house at 123 Main Street is worth $100,000. Whether that's the market determining it or it's bought for $100,000, but at one moment in time, the house is worth $100,000.
Okay.
If there's debt on it, say there's a traditional mortgage like what I typically live with day to day, say there's a $70,000 mortgage, first mortgage on the loan. Well, the equity on the house is now $30,000.
So it's the difference between what the house is worth and what you owe on it.
Correct. So the HELOCs tends to be a second loan behind a first mortgage position.
Okay.
They'll really won't go into a third lien position. Typically are second or first lien positions. The majority of the time, there's already an existing mortgage on that house.
So using your example, I have a $100,000 house. I owe $70,000 on my mortgage, which means I have $30,000 in equity in the house.
Right.
Does that mean that I can just come to the bank and say, hey, I want a $30,000 loan?
No, because the bank is going to want to have some equity in that house so that if there's any fluctuation market-wise, it doesn't find itself in a position where it's upside down. So there's a ratio. It's called loan to value, and it's basically what it sounds like. You add up the debt on the house, and the proposed debt, you divide that by the value of the house. The bank shoots for, on a HELOC, to be no more than 89.99% LTV. So there's like 90 is a threshold that they don't really want to be above.
Okay. And that just gives you
Some wiggle room.
Yeah.
Yeah. So in this scenario, house is worth 100,000. First mortgage is 70. We'll go 20.
Okay.
On a HELOC, and that puts us at just at 90%.
Okay.
LTV.
This brings up an interesting dynamic. There are people out there who, for whatever reason, they take out a loan against their home. They take out a HELOC. They have a mortgage. And then, they lose their job. They get laid off. Something happens. I mean, these are real world things that could happen, right? So now, again, ideally, if you go to your bank and you say, hey, listen, I've been laid off from work and I'm looking for work. I'm looking to try to find a job, but your chances are your bank or your lender is going to try to work with you in that situation, within reason.
Yeah.
But ultimately, you took out a loan. Right. And part of that loan is that you agreed to pay back that money with interest. So what happens
if it doesn't calculate in, when the bank makes a loan, it's anticipating you paying the loan. Right. It doesn't say like, well, we'll take your house.
Yeah.
So this is always a last resort.
Let's talk just a little bit about how this actually. So that's the bad side of lending. I don't want to say bad side. It's just the reality of lending, I guess I should say, is that it's a loan. You're supposed to pay it back, right? And there are things that happen if you don't. But that doesn't happen typically, I would say, very often. I think most people, the banks are. I've gone through the process of buying a house, and we talked about this in the first episode, which was actually the only two-parter so far because Dave is just full of information. No, I was going to say full of good information, and then you go and try to disparage yourself. But when we talk there is a lot that goes into evaluating the worthiness of a person to go through a mortgage. Right. So ideally, and if you want to know all about that, go back and listen to episodes 1, A and 1B, because we talk about that in depth. But because of all of that, I would argue that there's not as much in the way of defaulting on the mortgages and stuff as there might have been 30 years ago. Maybe I'm wrong. You're kind of doing the thing. So
it's actually, the regulations are a little more stringent now as far as protecting consumers from foreclosures that are considered predatory or whatever the word you want to use.
Okay. But still, I mean, I would argue that the banks probably have a better idea of whether or not you really can make your payments though, too, now.
From an underwriting perspective, yes, we have more time on. We've got better models on predictability of who pays what, when people are going to pay. And so, yeah, that does factor into it.
Okay. So I guess the whole thing I was leading up to was what's involved in evaluating whether I can get a home equity loan.
Okay.
Do you go through the same kinds of processes?
You do not. This process is significantly less formal and uniform. Because mortgages tend to wind up, investors tend to buy huge pools of these things and turn them into security instruments and other things. So that they're able to do that, typical first mortgage underwriting is very formalized. It follows basically computerized rules that does actually a lot of the underwriting as far as the credit decision being made.
Okay.
We use a Fannie Mae underwriting system basically that makes it pretty much makes the credit decision for the underwriter.
Mm-hmm.
HELOCs are traditional credit, what I consider, real credit. The HELOCs, at least done at this bank, it's a person underwriting it, picking up a credit report and a pen and starting to mark up the credit report manually calculating out the debt to income and things like that. It's because these HELOCs are not going to wind up in a portfolio that could wind up being sold off or anything else like that. It's less formalized, and it's more of a common sense business decision on whether a deal works or not.
Okay.
So it as a result, it's a lot faster. There's less documentation required, and sometimes that documentation is very tedious for people to chase down and get, because again, it's just less formalized and less uniform.
Okay.
So it's a much faster process to get approved on a HELOC.
Okay. So essentially, if I want to get a home equity line of credit, and I keep saying, I keep trying to not say loan, because they are not loans in the traditional sense. They are lines of credit. So I'm looking to get a home equity line of credit. I have a home. It has equity in it, meaning that it's worth more than what I owe. And I have at least that 10% buffer, whatever it is. So I decide I want to put, what can I use it for? What can I do with that kind of a loan?
You can use it for working on the house, doing renovations to the house, financing that. People use it. You could have a lot of credit card debt, an unsecured debt that you're paying high credit rates on, interest rates on, and you can refinance that at a significantly lower rate using the funds from that credit line. You could go to Greece.
Specifically, nowhere else.
Yeah, we have a deal with the Greek travel bureau, but I mean, people will use them for,
I only want to go to countries that have white walls and blue roofs.
Yes, right.
That's
so. I mean, you can use it for your own purposes.
Are there any restrictions?
No. I mean, if you've got a kid in college and you've got expenses from that, for that.
Yeah.
So it's. We don't really.
Do you ask? Is that something you have to tell the bank? Like,
we ask just because it's part of the credit process, but it's usually not a. Now, if you're saying, well, I'm going to use it to do something illegal, then yeah, we probably would care then.
Yeah, but you got to be a special kind of person though to admit that, right?
Yeah, or you're just really honest. But as long as it's
the most honest person doing illegal activity.
Yeah. Well, we like honest customers. So
as long as it's legal and ethical, we don't really have too much concern about what the use of the proceeds are.
Gotcha.
But
because what's backing up the loan, right? The loan is being backed up by the home.
Right.
Right. So in the end of it all, you already know that's why when you take out a mortgage, you have to say, well, I'm taking out a mortgage specifically to buy a house. So I'm taking out a car loan. I'm doing it to buy a car.
Right.
And the car is actually your collateral. The home is your collateral. But for this, you already know that the home is the collateral. So
you already own the home.
Yeah.
HELOCs are not really used to purchase homes. So you already own the home. The only time where an underwriter may have some say in the use of funds is during the underwriting process. They're marking up your credit report and they're calculating your debt to income. And debt to income, it's another fairly self-explanatory ratio. It's your debt service that you pay every month and payments over your gross income. And typically we don't want to be above 43% debt to income.
Yeah.
Which means the other 57% of your gross income is spent on taxes, groceries, gas, utilities, things like that. So if as they're working through the deal and they see it's got a lot of credit cards with some high balances on it, the underwriter in that circumstance may say like, hey, if we were going to consider this, you need to pay off and close your Bank of America card, your Best Buy credit card, whatever else. And typically that's just to get somebody into a reasonable debt to income.
Okay.
Those are the circumstances where an underwriter might actually say like, this is at least some of these funds are going to be used for this purpose. Yeah.
So let's and maybe I'm doing this a little out of order, but it's coming to me. So let's focus a little bit too about, okay, I'm using it to, as you said, maybe do home improvements, right? So that's one way to actually increase equity in your home. You can increase equity in your home a couple of ways. You can pay down your debt, right? Or you can add value to the home.
Right.
So you have some people that will take out a home equity loan for, I don't know, $30,000 to stick with the same example we've been using, right? And they put,
I think we said 20.
20,000. Okay, I'm sorry. Yeah, it was 30,000, and then
with the buffer.
Yeah. So I have a $20,000 home equity loan. I put a $15,000 deck on the back of the house, right? Which theoretically adds value to the home, right? So at some point, like, do homeowners typically get their homes appraised regularly? Do you do an appraisal for a home equity loan to make sure there's actually enough equity in the home still?
Yeah, so we are required to get a valuation of the collateral of the home.
Okay.
There's a couple ways we can do that. One is a full-on appraisal like you would get for a first mortgage. Those typically cost $500 or $600. The last 6 years, I think the bank's paid all but $295 of it, and I believe right now they have a special going on through the end of the quarter where they're actually covering the full amount if an appraisal is necessary.
Mm-hmm.
The other,
that's here though. I mean, that's
here,
at one bank. I mean, every bank's going to be different, but yeah.
I'm just throwing that out there.
Yeah,
because I'm sure somebody from the bank's going to be listening to this and call me. So the other way we can do it is basically based on tax assessed value. So every county in Pennsylvania has, it's called the state actually kind of takes a look at typically how long it's been since the last reassessment, countywide reassessment, and then it's called the common level ratio. So it might be 6.5 for county X. It might be 2.0 for county Y.
Okay.
Mostly it's just depending on how much confidence the state has that the tax assessed value is actually even remotely close. Thank you. Remotely close to what the actual market value is. So as a result, what we can do is we can take the tax assessed value, multiply that by the common level ratio, and have a ballpark figure for what that market value might be, just using the tax assessed value.
I think about that because I think, just like in the example, you have homeowners who will try to add value to their home. So, they bought a home 10 years ago. It was valued at $150,000. They've put, a significant amount of time, effort, and money into doing things to the home. And now, if you were to resell it, it might be worth $200,000.
Right.
But if you don't get an appraisal, then, you have to sort of have that in mind. At the same time, unfortunately, you have people who buy a home and then just let it go to pot. Right. And so they bought it for $150,000 10 years ago. They've done nothing to it. The roof is caving in. The basement is leaking. But yet you don't know that necessarily. Right. So
when would you require an appraisal versus when you would rely on the tax?
Is it based on like how much they're asking for?
Well, a part of it is typically if somebody's asking for more than $150,000, that automatically triggers an appraisal.
Okay.
But also what we'll do is we will look at what we will do that calculation using the common level ratio and the tax assessed value, subtract what debt we know about, and that we're typically looking at a credit report and we can see a Wells Fargo or whatever else first mortgage. And you can pretty much tell right there whether using the tax assessed value is going to work. So if the tax assessed value is coming at 90,000 and they have a 70 and they want to borrow 20, we're going to have to go to an appraisal at that point. That's going to be much more in depth. That's going to be people walking in the house, taking pictures, everything else, and really should get a to the moment idea what the market value is. They're looking at houses that have sold recently in the area that are similar in quality, size, amenities, things like that. And that appraiser is then coming up with what should be the market value today. It's still some estimate. It's not exact science. There's some art to it.
But that's where that wiggle room comes into.
Right.
Yeah. I was actually thinking too, I didn't know, if the length of time that you've owned the home would play into it. Like if it was like, well, you only own the house for 5 years, how much could it have changed?
Right.
Versus you've owned the house for 35 years. I don't know what you've done to it.
Right.
Yeah.
And since we're talking about home improvements, there are people who will say, well, I put $50,000 into this house, but 30,000 of it was a pool.
Yeah.
The common wisdom is that you don't get your money back on pools.
Yeah.
It's not dollar for dollar.
If you're living in Florida, maybe, because every home in that area of the country probably has a pool. Yeah. California, Texas, things like that. But if you're living in the Northeast and you put a pool in, your interest is your insurance. Thank you.
Yeah.
Is probably going to go up more than what the value of the pool is.
Yeah. And in some cases, the pool actually can be a detriment when you're trying to sell the house, because there are a number of people who aren't interested in having a pool.
Get less land.
In Pennsylvania.
Yeah.
Yeah. So, I mean, there is always kind of a discussion when you talk with people like, well, I put $50,000 into the house. Was that kitchens and bathrooms? Because that's usually you get more for your money.
Yeah.
Was it a pool and, a roof, which you don't really, everybody expects the roof to work. You don't really.
Right. Yeah.
You typically don't get a lot more for having a roof put on 3 years before you sell it, just because everybody expects the roof to work.
Yeah. I guess the only advantage you have there when you're selling, because I know it's funny you said 3 years, because that was the length of time whenever I was looking at our house. They had just put a new roof on about 3 years prior to that. And in my mind as a buyer, while it didn't necessarily add value to the house per se, it was a weight off my mind that, well, I should have
20 years.
Yeah, I should not have to worry about this for at least 10, 15, 20 years, right? Yeah.
Right.
But
anyway,
would I have paid more because it was just done? Probably not. Not unless there was a hole in the roof and I was like, well, I'm going to have to fix that. Now,
if it's a jump ball between two houses and you have a 20-year-old roof and a 3-year-old roof, that may be enough to push you over.
Yeah. Yeah. Typically, though, I think that there's a lot of TV programming and things out there that give people this sense that, well, if I just put $10,000 into this house, I'm suddenly going to sell it for $1 million, even though it was only worth $250,000 when I started.
Right.
That may or may not necessarily be true.
Yeah.
Plus, you're not necessarily a professional designer, contractor, whatever. So a lot of your home improvement costs are usually tied up in having a skilled individual doing the work.
Right.
But that is something to keep in mind, that a home equity loan can be used to theoretically increase the value of your home.
Right.
I
mean, you would hope it would be used to increase the value of your home. So it's, and instead of going outside and borrowing unsecured or from some other source, the rates are going to be fairly low because it's secured by your house, and you should get the amount of money you'll save in paying interest. A higher interest rate over time will save you well.
So I know we discussed interest rates at the sort of the top of the show, but I wanted to circle back to just one other thing, because I think you did talk about this, and if you did, I apologize, because I must not have retained it in my brain. But home equity lines of credit, you said they can last for many, many, many years,
correct,
right? So are the interest rates variable?
Right. The rate follows prime.
Okay, yeah, you did say that. So it'll float up and down. So, okay.
Right.
But
now there are floors.
Thank you. Yeah.
Typically, there's a floor and a ceiling, so that the bank won't be in a position where if say prime went back to 2% or something like that, that's not even covering the bank's expenses on maintaining the line. So it obviously doesn't want to do that. So the bank will make a decision on a floor rate. I think right now the floor rate's 3.25% if the loans, again, speaking for AmeriServ, just as an example, we're at floors 3.25% for 75,000 or more, and 4% if it's less than 75,000.
Okay.
And again, that differential is just the profitability of.
Yeah. But, and then you said there's also usually a ceiling of some sort too, correct, where you as the borrower know that, all right, absolute worst case scenario, my interest rate's going to be X.
Yeah.
And no matter what happens, it'll never go above that.
Right.
Right. So, and typically I would probably assume that that's still going to be less than a lot of credit cards.
Yes.
Yeah,
it will be a lot. If you're in a situation where you've hit the ceiling, your credit card companies or your credit card rates are probably,
yeah.
If the credit card companies are still even in business at that point, they're going to be astronomical.
Yeah,
it's a very high ceiling. So, or not high, but it's there's a lot of wiggle room between the floor and the ceiling.
Yeah.
So it should just float at prime. Prime goes down. Well, that's to your benefit. Prime goes up. Your payments go up a little bit.
Yeah.
It's still basically using a market indicator of what the cost of the actual funds are going to be.
Okay. So how many home equity loans typically do you do in like a year? I mean, is it a pretty popular product? Is it something that people use a lot?
It's a very popular product. I don't know the number because I'm not.
Well, that's okay. But I mean, it's not something you do rarely. I mean,
No, it's, I mean, they're floating in probably every day. There's one or two HELOCs applications that in every day.
Mm-hmm.
So, I mean, it's a very, like speaking from the bank's perspective, we have a very competitive product. It offers a lot of flexibility. So a lot of people are interested in taking us up on that, that product.
So what I was looking at, one of the numbers that I rattled off at the very beginning was the average HELOC balance per account right now in the country, across the country, is about $26,000. So that's really not
a lot.
I mean, I was going to say, I mean, to me anyway, that doesn't seem very, very high.
So you're not taking out a line of credit for the total value of your house necessarily.
Yeah. I mean, there are probably some credit cards out there that have a balance, that have a $25,000 credit limit.
Yeah.
You know, so if that's where you're at, it's not like you have to take out a $300,000 home equity to do a home equity loan. Is my point. I mean, you can do stuff there's probably a floor though too. I would imagine there's probably a point where the bank's like, look, I can't give you a home equity loan for $4,500.
Right.
Like,
yeah. $10,000 is our minimum.
Okay.
And again, it's just a question of the return on investment for the bank.
Mm-hmm.
If a $4,000 credit line paying at prime isn't going to make enough to make it even worth carrying that loan in the book.
So going back to one of the things we talked about before in figuring out how much equity is actually available in the home. And I said, you know, if you've only owned the home for 5 years, chances are your estimated value is probably correct, right? Because you've only had your appraisal was done just less than 5 years ago. But you may not have paid down enough on your mortgage to even qualify for a home equity at that point.
You know, if the housing market hadn't been so volatile in the last 5 years, I'd be inclined to agree with you more. But I mean, we have seen remarkable increases across the country in housing costs. So, I mean, just sitting on a house and paying your mortgage in some areas can lead to 30-40% increases in the value of the house. We don't live in such a volatile area to our detriment in some way.
Sometimes stability is good.
Yeah. Yeah. We don't see the highs and we don't see the super lows that other markets have, markets I've happened to live in.
Mm-hmm.
So, but yeah, it's typically in a normal world after, you know, not thinking about the last couple of years. Yeah. You don't see that much change.
Now I'm asking you to speculate, and I'm going to preface this question by saying that because I'm asking you to speculate. But based on your knowledge, your past history, your experience in all of this, is this another housing bubble? Are housing costs, are housing values getting to a point where they're being overestimated, or is, you know?
You would think, but the issue is there's not a lot of housing available right now. So the supply is fairly low, and the demand, even though rates have had a negative impact on the demand to some extent, the supply of good housing and like even in our market is very low. Houses don't stay on the market for very long. And typically if a house is on the market for a while, it's either dramatically overpriced or there's something wrong with it that people are walking by.
So people are looking to buy.
People are looking to buy.
Is what you're saying.
And there's not really a lot of inventory.
And why is that? I mean, is it that the sellers think that they can't get their value out of the house because the interest rates are up? Or
well, there is a fairly large chunk of the population of homeowners right now that are in rates in mortgages in their existing homes in the 3s, in some case in the 2%. And for them, and they may want to move into a bigger house or, you know, move on to another house. But if they do that, they may be dealing with rates in the 7s.
Yeah.
So they're sort of staying out of the market as a result. They're not selling because they don't want to have this huge increase in their mortgage.
So do you think that's leading to more HELOCs? Because are people like trying to improve what they have rather than moving to a different home?
It has to.
I
mean, it really has to, because we're in a situation where, and this was actually sort of prefaced by COVID too. People were spending a lot more time in their house and looking around and realizing, like, you know,
I could do this. I could do this.
This bathroom is straight out of the 70s. Maybe I should get this bathroom redone or do it myself or whatever else. So there already was sort of a push to renovate the houses that people already are in. And again, this is where the HELOC sort of plays into that, because people are going to stay in their houses for longer while they ride out the current rate environment.
Mm.
And we all sort of hope it will go back down to something similar to where it was.
Yeah. I mean, I see a similar trend. My dad has been self-employed as a mechanic for over 50 years, and he has arguably never been busier.
Yeah.
In terms of repairing vehicles, because people don't, there for a long time, there was no inventory for new vehicles. First of all, the mentality that people had of, oh, well, it needs $1,000 worth of work. Never mind. I'll just go buy a new car, is giving way to a more old school mentality of, hey, I got to keep what I have on the road because I
can't buy a car for $1,000.
Right. You know, so I would imagine homes are probably in a similar boat, or people
Similar
are
situation.
Yeah.
And people are staying in their cars longer, I think, because they may have bought their 2020 whatever at 0%.
Mm-hmm.
And now they're looking at 7%.
Yeah.
And obviously you can afford a lot less car than you could.
Yeah. And that kind of goes back to the HELOC thing too, of, you know, a 7% mortgage rate is comparatively high compared to what it was, say, 5 years ago.
Right.
Right. A 7% rate on a HELOC compared to your 24% rate on a credit card.
Yeah.
Right. So that rate number is relative.
Right.
Right. As to whether it's high or whether it's low.
Right.
And that's what you kind of got to think about too when you're getting a HELOC and you're saying, hey, you know, it's a 7% rate on a HELOC. Why would I do that if I get a 7% rate on a mortgage? Well, 7% on a $25,000 HELOC is more than reasonable.
Right.
7% interest rate on a $350,000 home is going to be a lot more money.
Right.
Right. So
and the other thing people sort of get into it's a bad habit, but they may have a credit card and they're just paying the monthly minimum, which is typically just interest, accrued interest.
Yeah.
And they're just banging along paying the minimums. They could have $40,000 in credit card debt, and that interest over time at 25% is a lot of money.
Mm-hmm.
So you can use a HELOC and, first of all, knock your minimum payment. You know, even if you just paid what your minimum payments were, you're now paying the creded line down significantly.
Because you're paying on the principal as well as
Right.
the interest, right? Yeah.
Yeah, because you went from 25% to 8%, 8.5%.
Yeah.
So 8.5% as of today. So, I mean, that savings alone you can use to pay down the balance on the HELOC.
Yeah.
And again, the great thing about a HELOC is the faster you pay the principal down, the more room you make to be able to use it again.
Mm-hmm.
So, I mean, you could be paying off your credit cards 1 year, and 3 or 4 years later, you have to dig up your front yard to put in a new sewer line or something. And you have availability on your credit line.
Yeah. Excellent. What do you got, Jeff? Anything? It doesn't help that we have Jeff is competing with two very long-winded people.
Yeah.
Because I talk a lot.
I'm generally pretty quiet. Yeah.
Yeah.
This was a learning experience for me. You know, I get to hear the podcast early, I guess.
Mm-hmm.
Yeah. Instead of having to edit around, which you're going to have to do some editing on this. We all know that, right?
Yeah.
So
Because I use typically a lot. So
It's all right.
typically we're gonna change it using AI, and we're gonna change it to like Peacock, and so
okay,
or something completely off the wall, so that every time it goes up, people are gonna really notice it.
I'm into it.
Yeah. So, well, thank you very much for your time and for your what else is there anything before we leave you? Is there anything else that we should probably know, or the average person that may be looking into doing a HELOC should probably know that we didn't cover? Because you know this better than I do.
Yeah, I mean, we talked about even if you don't have a need right now for a HELOC, it's a good idea to have one in place, because that scenario I just threw out where you suddenly have to dig up your next door. My next door neighbors have.
Yeah, you're digging up your next door neighbor there.
I just slurred that one a little bit, but my next door neighbors just had a huge surprise on their sewer line.
Ooh,
like a huge dollar amount.
Yeah.
So having a HELOC in place, even if it's just sitting there, so that if you had a situation where you need to pay Roto-Rooter to dig out your sewer line, and you obviously want that done today,
yeah,
you have the funds available and they're there. The cost of carrying a credit line without using it at all is $25 a year. It's just an annual renewal fee, $25 to have the ability to tap into equity. To tap into your house's equity to pull money out. Emergency is
Yeah. And I mean, you make a good point, because I remember a time whenever I was a kid, it was Easter Sunday, and my parents' water heater just blew up.
Yeah.
Right. I mean, what do you do? And I mean, thankfully my dad, I mean, we live in a relatively small town. Like, my dad knew the owner of the hardware store down the street, and he was able to call him up, and he went down, opened up the hardware store, and sold him a hot water heater. But the end of the day, how long can you realistically go without a water heater in your home? Right. And that's just one example. And you're probably talking, $800 for the water heater, maybe another few $100 to have somebody come out and put it in for you if it's not exactly the same, because it has to be exactly plumbed right and everything. Weird things like that. I mean, being a homeowner comes with all kinds of jacks in the box.
Yeah.
So I think you're right. I think having that availability and that peace of mind, if nothing else, to just look, I don't want to have another payment, but it's better to have another payment and be able to handle an emergency today than not.
And as opposed to a home equity loan with the line of credit, you don't have to use it.
Mm-hmm.
You don't have to use it.
So there's no minimum.
There's no, you don't have to maintain a minimum balance or anything. Like, if you get, once a year, we hit it for $25 for a fee, and that's mostly just to cover the cost of postage.
Because we have to send you a statement, a privacy statement.
I mean, so you literally can keep a reserve in place for $25 a year that you can access immediately. I mean, if you bank with AmeriServ and you have a line of credit with AmeriServ, you can go on your phone and transfer however much you need to through the app, the banking app. So if you run into a circumstance where you have an emergency and you need to get cash, transfer money directly into your checking account like that.
Yeah.
So yeah, I mean, it's a good thing to have, even if you don't have an immediate need for it. Because if you have an immediate need for it, it's too late. Yeah.
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 Yeah. Especially if it's Easter Sunday or something.
Right.
Like
exactly.
That, you know what I mean?
Circumstance.
But it's something else that you said about too, like that actually, I know you said that, figuring out how to calculate your credit score is an enigma.
Yeah.
But one of the things that does go into calculating your credit score is available credit that's unused.
Right.
Right. So if you have a $25,000 or $35,000 line of credit out there, home equity line of credit out there, and you're not using it, it doesn't hurt your credit score. If anything, it helps your credit score, because you're showing that you could be using this money, but you're not.
You can live within your means.
Yeah.
What that tells a credit underwriter is you're able to live within your means. If you have several credit cards that have zero balances, you're able to exist on your day-to-day expenses are covered by your cash flow, basically the cash that you have on hand that you get from your income or from if you're retired or whatever else. So that shows stability on the part of a borrower from an underwriter perspective.
Yeah. Okay. I'll ask another question, because when it comes to home equity, and we're talking about the equity itself in your home,
right?
What you said, adding a roof on or fixing your roof probably doesn't add. What does add more equity to a home typically?
Well, I'm going to put on my former realtor hat and tell you that you can't go wrong with updated bathrooms and kitchens.
Okay.
Fresh wall. If you have a house with paneling, we've talked about in the past.
Oh yeah.
So I mean,
I got
some of it's also some of it is basically, if you have a house that looks straight out of the 70s, it's not going to be as competitive with a house that's fairly current and up to date.
Yeah.
So I mean, the trick is to try to keep your house remodeled to an extent that it doesn't seem like a time capsule.
Yeah. And, we always say, because I'm in the same boat as you, I still think of 1970s being 30 years ago.
I know.
But it's not. I mean, if your house was built in 1990, you're already 34 years in, right? So there's a different mentality too, depending on what age group you're in when you're listening to this, what you consider quote unquote old.
Right.
Right. But just keep that in mind. The trends change, tastes change. If you have seafoam green and pink in your home, which was typical in the early 90s, it's probably not very, probably not something that's going to appeal to a person who's looking at your home today.
Right.
But things like paint and things can be changed. It's the core places, like you said, a kitchen where you spend a lot of your time, your bathrooms where, you updated fixtures and plumbing that works and nice showers and things like that really, I think, add value to a home.
Right.
So,
and if you happen to be friends with a realtor, invite them over for dinner. After there's been some conversation about another topic, you may want to ask them like, hey, if I was going to throw $30,000 at this house to try to get
40,000 out of it. Yeah.
What would you recommend? And they probably would have an opinion.
Yeah. And if you are a DIYer, for all, just make sure that if you're DIYing, you're DIYing it right.
Yeah, exactly.
There's been a lot of trend toward DIY work, and there's nothing wrong with that inherently. But if you're doing electrical, if you're doing plumbing, if you're doing anything that requires inspections and professional people involved,
this feels like a disclaimer.
It is kind of a disclaimer. I'm just throwing it out there. Please, don't do that kind of stuff yourself if you're not qualified to do it.
Right. Some things you can't just learn on YouTube.
Yeah. I mean, if you're learning how to paint on YouTube, you're probably good.
Yeah.
If you're learning how to do, main stack plumbing, might want to have a pro.
Yeah. They're going to charge you more for fixing your mistakes anyway. So
that is true. Yeah. That is true of cars too, I might add.
Yep.
All right. Well, Dave, thank you very much. I mean, as always, I know we joke around a lot, but you are very knowledgeable, and we do appreciate you doing the show and coming in and sharing your knowledge with people for free.
My pleasure. Wait, for free?
Yep. Yeah. See that water bottle? That's yours.
I'm taking them both. No water for you, Jeff.
Oh, yeah. Jeff's here. All right, everybody. This podcast focuses on having valuable conversations on various topics related to banking and financial health. The podcast is grounded in having open conversations with professionals and experts, with the goal of helping to take some of the mystery out of financial and related topics, as learning about financial products and services can help you make more informed financial decisions. Please keep in mind that the information contained within this podcast and any resources available for download from our website or other resources relating to bank chats is not intended and should not be understood or interpreted to be financial advice. The host, guests, and production staff of Bank Chats expressly recommend that you seek advice from a trusted financial professional before making financial decisions. The host of Bank Chats is not an attorney, accountant, or financial advisor, and the program is simply intended as one source of information. The podcast is not a substitute for a financial professional who is aware of the facts and circumstances of your individual situation. I think the biggest takeaway from our discussion with Dave O'Leary today is that a home equity line of credit can be a fantastic way to borrow just as much money as you need, when you need it, and at generally lower rates than what you'd likely find from a credit card. That said, it's important to never overextend yourself by borrowing more than you can afford to repay. As always, I'd like to thank our producer, Jeff Matavish, for his excellent work with the editing, distribution, and transcription of the podcast. If you haven't yet subscribed, we'd really appreciate it if you would. We also love to hear back from our listeners, so if you have a question or comment, please visit AmeriServ.com/bankchats and leave us some feedback. AmeriServ Presents Bank Chats is produced and distributed by AmeriServ Financial Incorporated. Music by Rattlesnake, Milo, and Andrea Kalitkin. You can find the podcast on any of your favorite podcast apps or by visiting our website. For now, I'm Drew Thomas. So long.